Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our program, our podcast that we do weekly, we give you the good, the bad, the ugly on all things real estate. I know many of you are probably used to watching CNBC and the local stations to get your real estate information to find out what's going on with interest rates and the economy, but I'm sure that many of you realize that most of the stuff they report is after the fact, and my guest and I, Louis Camerosano, who speak weekly, we're always trying to tell you what's coming in the future, not necessarily predicting, but trying to give you arm you with the information that you need to make smart real estate decisions right now, today, and letting you know how, the budget crisis that we have in Congress, the Fed crisis that we have with them artificially manipulating interest rates for over 3-4 years now, how that's going to affect interest rates in the short term and the long term, so that you're able to better make a smart decision on you and your real estate needs. Louis, how are you doing today? It's good to have you on, as always. For those of you not familiar with Louis, the former school teacher, a former attorney, and a former general manager of a major real estate portal. He's often cited in the media as a real estate industry expert in the Wall Street Journal, Forbes, Smart Money, MSN, and numerous others. How are you doing today, Louis?
Doing grand, Ryan. How are you?
I'm doing well, sir. It's like I was just talking to you earlier. It's great to be back from vacation. I was on a little hiatus there, and now I'm back to reality. I was in Aruba, and a much different economy, obviously, than we have going on here. 90% of their business is from tourism, and they get about 1 million people a year there. But interesting enough, though, one thing I did take away from there is that, they really do cater to the United States quite a bit. If you read all their newspapers down there, I would say 90% of it all has news about what's going on in America, right? Now, obviously, that's done intentionally because a lot of the tourists are American, but I just thought it was pretty interesting because the only thing that really had stuff about Aruba and that country were the advertisements trying to pump you into the hotels and the restaurants there, but a lot less of any news of any sort, you know what I mean? So it was an interesting thing to see. I could pick up the newspaper daily and kind of thumb through it, but never saw anything really other than they would note when one of the tourists would hit the jackpot in one of the local hotels. That was news. That was news for them. So obviously now that I've gotten back, our last show about 2 weeks ago, we had discussed what the Fed was going to do, whether they were going to taper, and obviously now that I'm back, the Fed obviously decided not to do anything. I had spoke, and you had said too, you thought that they might taper a little bit, pulling back on treasuries. I thought they wouldn't do anything, and that's pretty much exactly what they did. But the irony of all that is, you have a blog post on your site, Smaulgld.com, that's SMAULGLD.com, that right behind that, one of the Fed President Bullard came out and is already talking that it was a close call and that potentially in October they could want to pull back because as long as the data supports it. The data hasn't supported anything, Louis, and you and I have talked about this. The data hasn't supported anything that the economy is actually improving in years now. So what would change between September and October that would actually lead them to believe that this would be a smart decision to do something?
Absolutely not, Ryan. Congratulations on the call, because we've been speaking for months saying the Fed is bluffing. They're just talking tapering. And you called it right away. You stuck to it and you said, no, they can't taper. They learned their lesson. They opened their big mouth about tapering, and interest rates went from the 10-year note from 1.6 to 3.0. And Bernanke even admitted that. The reason they didn't taper was because of what he called, always have some code, tightening financial conditions that were caused precisely because they started talking about taper. So you had rightfully said a couple of weeks ago that they've learned their lesson. They don't want to make that mistake again, because if they even do taper just a little bit, they're going to have to really reverse, and it's going to cost them more money to go back and try to reverse the higher rates by printing even more money. So they did the safe thing by not tapering, and, the rates went back down. But you have to question why the St. Louis Fed president trots out there the next day talking about tapering if the data supports it. Because as you say, what's going to happen in the next 3 weeks to change the underlying economic landscape, which has not been good since the recession started? Because if you remember back in June, Bernanke said, we can't have higher rates because the economy is weak and, quote, would tank if rates went higher. And he kind of saw the economy starting to tank since he said that because rates went higher. And the irony is that he was thinking in June that he, the Fed, could keep rates low by not raising the Fed funds rate, and that would be accommodative enough. What he has learned since is that rates are low solely because the Fed has QE in place and spends $85 billion a month, and when they don't give any indication that they're going to pull that $85 billion a month, rates will stay low. So he was trying to sever the cord between keeping rates low and the QE program when you can't do it. The rates are low because of QE and because of the expectation that QE will stay in place.
Yeah, and it is interesting. I'm curious if Bullard actually has some really good friends on Wall Street that are like, paying him money to go out there and say stuff like this, right? Because
it did knock down gold and silver, which immediately rose on the expectation of more QE.
Yeah, and I'm almost trying to figure out, because obviously there's multiple Fed presidents and they all say different things, and it's almost like the Fed enjoys this for them to have differing opinions on both sides, which basically allows everybody it be a mystery as to what's actually going to happen, and they continue to go down the same path where they'd be better off to just shut their mouth and say, guess what, we're not going to do anything until we have economic data for at least a 6-month period that says things are moving in the right direction. Why would it be okay if we have data just for 1 month?
3 weeks,
all of a sudden,
really.
Yeah, for a couple of weeks, that all of a sudden we've turned the corner. Because then, if they do the taper, and then they get the next month's data or the 2 months data after that, and things are getting much worse, then they have to come right back and say, oh, crap, we were buying $85 billion. Right. We're buying $85 billion worth of treasuries and mortgage-backed securities, and now we've let rates rise up so quickly because we started tapering, which is going to have the natural consequences and implications of basically a pullback or to pull money out of mortgage-backed securities and treasuries. We're going to see interest rates rise because we've already seen it happen over the last couple of months where rates have risen over 1%. Now, by the Fed not tapering, for those of you that are new to our podcast or just unsure as to what quantitative easing is and what the Fed's been doing, they've been purchasing strategically mortgage-backed securities and treasury bonds. Now, as far as mortgage interest rates go, the bigger component to pay attention to is just the mortgage-backed security side, which every time that the Fed purchases, they've been buying about 80% of the mortgage-backed securities that are issued. The more that they continue to buy these, it actually suppresses interest rates. So if they were to start to taper, they would start to pull back their purchases of these mortgage-backed securities, naturally interest rates would rise. Now, over the last 3 months, the whole reason why interest rates were rising, even though the Fed was continuing to buy these securities, is because they continued to talk about when they were going to start pulling back their purchases of mortgage-backed securities, which was supposed to happen in September and obviously didn't. Now, so where do we go from here, knowing that the Fed now has basically led us down that path for so many months and then decided that the data doesn't show anything, we're not going to taper? I would continue to hold my, stand pat where I feel things are going is that they're not going to do anything for the foreseeable future because they already know that they can't. They know that anything that they would say to drastically pull back quantitative easing or the Fed purchases of mortgage-backed securities is going to directly affect the real estate market, which is basically the only thing that they've been hanging their hat on for how long. So realistically, when we're talking about interest rates, and I've had 2 questions I get asked all the time are, where do you see interest rates going in the next 6 months to a year? And the second question is, should I buy or sell a home right now? And my answers are almost pretty much the same all the time, or it's, you have to make a decision based upon where we're at today and not worry about what's going to happen in the future. I mean, Lewis, if you were a gambling man, would you really want to gamble with your money with the way the Fed treats everything? I mean, I mean, we're actually almost starting to catch on with their every move only because they're becoming completely predictable. Before, they weren't as predictable, but now it's almost every time that we start to see them talk about doing something, we know that inevitably they're probably not going to do anything, right? So I just can't see, if you're a consumer, where you're saying, you know, well, I want interest rates to go back to 3.5, and then I'll definitely buy, because guess what? We did get a little bit of pullback in rates. Rates got better over the last couple of weeks. And not to mention, yesterday we had new home sales that came in at 421,000 versus estimated 420,000. That was a 7.9% gain from the much weaker prior period. Now, that information wasn't enough of good economic news to really persuade interest rates anywhere. Then we had 5-year Treasury auction results, which was not a big factor. And durable good orders actually came in at 0.1 versus estimates that ranged from 0 to 0.2. So, and the prior reading was revised downward to a dismal negative 8.2. And so we had some good positive and some negative news, but through all that, we actually had interest rates that have been getting steadily better over the last couple of days. And, Lewis, the reason why that's happening is because of the whole threat of government shutdown.
Yep.
Right? We had the threat of government shutdown. Basically, government's going to shut down. But then we find out yesterday that now all of a sudden they found a little bit more money, and now they're not going to actually run out of cash until October the 17th. Okay? How does it mysteriously they just find? Where do they find this cash? Do you know, Lewis? I'm curious as to where cash just pops up. You know?
It comes from Obama's stash.
Exactly. It's no coincidence that they just find cash. They're just trying to buy themselves more time. And, you know, I'm not a big conspiracy theorist or anything like that, but do you remember when we talked 2 weeks ago about how, you know, Obama was really pushing the whole Syria thing, and it was more of a distraction for anything else that was going on in the overall economy? Well, I found it was
first of all, Ryan, it was raised to the level as the most important issue facing the United States at this time. Mm-hmm. And it required swift and immediate action. Well, we didn't do swift and immediate action. It never was that important, and we haven't done it. So what are the consequences of having not done it?
That's what I'm wondering. And, you know, after Bernanke basically had came out and said they weren't going to taper, now we're at the point where, okay, so does it look like Syria even matters anymore now?
Well, you know what it is, Ryan, what you and I discussed and have discussed for years, that the Fed has never had any intention of tapering, has always wanted and needs to do QE, and will always come up with an excuse, something, for why they won't start slowing down the purchases and eventually shut down the purchases. However, they are reluctant to act as if QE is now a permanent feature of the economy because they're worried about losing confidence in the dollar and debasing the dollar to the point where you have hyperinflation. So, from time to time, and they've managed to keep this going for a long time, they come out, or one of their Fed presidents comes out and says, you know, we're just about ready to taper, so let's think about cutting back on QE. And then something comes up. Well, they didn't have anything in September other than to make the admission that the economy is weak, which means that they have failed. Because if the economy is still weak and still needs $1 trillion a year, you can't cut 1 penny of QE, then they haven't done their job. Now, you know in October, and they've already hinted, one of the reasons that they didn't taper was they're worried about the looming government shutdown and the debt ceiling and so on. Well, that's perfect, convenient cover in October not to taper. They don't even have to mention that the economy hasn't recovered like Bullard thought it might in the next 3 weeks. They can just say it wouldn't be prudent at this time to taper because until Congress, and they can just throw it off on Congress as if it's all their fault that we have financial difficulties, and they're just doing their part. And you know what's funny is Bernanke even said there's not much we can do about it if the debt ceiling isn't, or there's big debate and gridlock in Washington over the debt ceiling. But yet, he's still willing to try to do something, which is, oh, yeah, I know what we can do. The only thing we know how to do, we'll just keep QE going.
Yep.
So I don't know how much longer they can strain credibility, though, with this. And I'm shocked that people still listen to this. because this is now going on 5 years,
Right.
and it's $1 trillion a year. And even if they were to taper, which is this is a very important point, it would still mean they're still buying a large amount of securities every month.
Right.
Which would mean that's adding to the stockpile of securities that they have. And remember, they're shareholders, right? They've got to get paid back too. Well, how are we, the United States, going to pay the Fed back interest and principal on $3 trillion? Well, the only way we're going to pay it back is if the Fed rolls over those $3 trillion into more. So that means that they're going to have to probably double the size of QE just to keep things the same to roll over the existing stuff they bought. And the more they buy, the more they're going to have to buy. Well, anybody's thinking they're going to taper. The only reason I even thought they might taper was because they wanted to have some credibility and throw a little bone out there, for $10 billion, and then go right back to the printing presses. But there's no way they can sustain a exit strategy where this month it's $10 billion, then they cut it down to another $20 billion, and eventually in early 2014, there's no such thing as QE anymore. The economy is fine, and the Fed starts selling all the mortgage-backed securities and treasuries in its portfolio. That is fantasy. That can't happen. That won't happen.
Right. Yeah, and I mean, you bring up a great point, the fact that, they've been doing this for over 5 years, and obviously the economy hasn't improved like they thought it would by doing all of this. So they're now 5 years into it. They've been pumping all this money into the actual economy. It's actually not necessarily reaching the hands of the consumers. We all know that because, banks and whatever, they're sitting on it, investing it in the markets. It's not actually being passed down. Regular business owners and consumers don't have access to capital for their businesses or anything like that, which is one of the big problems that I see is actually the if you're going to pump money into the system, if it's only going to the big banks' hands, I mean, who's making the money here? It's not anybody but them. And your businesses are out here maybe struggling or looking to grow. Because not every business is struggling right now. There's plenty of businesses that are doing quite well, but they're looking for more capital, and they don't have access to it. Do we think that's going to change in the next couple of years? Probably not.
No, if you think, Ryan, what is the Fed doing with the money? Right. What they're doing is they're printing money and they're buying mortgage-backed securities. Who benefits from that? The only way the average person benefits from that is interest rates go lower, but that's basically bailing out the banks and taking those toxic mortgage-backed securities off their balance sheets. That doesn't put any money into the economy. It doesn't even put money in the classic Keynesian sense into public work projects. It doesn't do anything except bail out the banks and remove those toxic mortgage-backed securities from their balance sheet. And what does buying U.S. Treasuries do? Well, it has the impact of lowering interest rates, but it also helps fund the United States deficit spending. It doesn't add any new money into the economy, the United States economy. It just backstops the money that the United States is already spending in excess of what it brings in taxes.
Right.
So you're right. There's really no benefit to the economy other than what it's doing is backstopping the two largest too big to fail entities, the banks and the United States government.
But what it has created is the illusion that it's working because everybody feels since home prices have been rising and since the Fed has been artificially manipulating interest rates to drive them lower, low inventory of homes has actually pushed prices up. It gives everybody the sense that, well, they must be doing something right because, look, my home price is going up. Look
and my stock portfolio has gone up. My 401k has gone up.
Right, so everything...
That doesn't create jobs. That doesn't create productivity in the economy.
Yeah, and I mean, here in D.C., every other day, Lewis, I'm hearing of people that are losing their jobs or being furloughed, their income cut by 75+%. That's a big deal because you and I always talk, especially in the D.C. metro area, of how many jobs we have here, right? And all the government contractors and all those jobs that are created by the government and the government contractors, well, those are slowly but surely disappearing. Not to mention now we have the whole threat of government shutdown at this point. Once again, I think that's a farce as well, Lewis, because it's just like you said, the Fed is there. Do you think that they can't just go and borrow more money from them? I mean, all they have to do is go and ask them. We Will you give us $90 billion a month? Do you think that won't happen?
Well, they can print it. I mean, remember that people need to know that the Treasury doesn't have control over the money supply. The U.S. Treasury doesn't print the money. The Federal Reserve prints the money, and what does it do? It then gives it to the United States, and the United States does what? It issues Treasury bonds for the Fed to hold. So that's exactly how the U.S. government gets funded all the time anyway, is that the U.S. issues Treasury bonds, and the Fed buys them with money they print out of thin air. So you're right. It's a very simple solution. The Treasury just asks and does another bond auction, and the Fed buys it all.
So, yeah, and so what does that create? That creates the government basically saying we're going to go further in debt, which is the way the media is going to portray that, right? But at this point, we're already in debt. What does it matter? They have to continue this. They have to, because they can't pull back $85 billion in purchases per month and think that everything's going to be okay. Now, should that happen? Probably so, but that would basically make everybody, every business, every person, the stock market, the housing market, everything would fall on its face all at once, which is what they don't want. So
if they pull back, you mean?
If they pull back, right?
It should fall on its face once people realize that the Fed is just printing money to buy bonds and mortgage-backed securities with money that they print out of thin air, and they've done it for 5 years and they have no intention of stopping. That should frighten people more than them stopping, is the fact that they're intent on not stopping.
Yeah, but I think, there's not enough people that actually understand.
Correct.
What's actually taking place, and that's, part of why we do this podcast is because we try to break it down on a more elementary level to let people know what's actually going on. And, when I talk to people every day and they're like, hey, did you hear that the Fed didn't taper? And I'm like, yeah, I heard that. And do you understand what that means? And most people
to them it just means lower interest rates.
Right. Yeah, I mean, that's all it is that, okay, well, this is where interest rates are going to be. And you said who else benefits from, what the Fed's doing? Well, the only way you can actually benefit from it if you're actually able to obtain a mortgage, first of all, right, at one of these low interest rates. So it is a benefit for somebody that's able to lock themselves into a long-term fixed rate, but that's a small percentage of the population that actually qualifies for mortgages these days. So not even everybody can actually take advantage of these interest rates. And there's still probably 30% of the people out there that are upside down in their home, and they still haven't recovered enough equity to be able to sell, so they still can't go and buy another home. So even though interest rates are low and they want to move, they still can't. Right. So, there's the select few that do have stable jobs, that do still make enough money, or can support carrying their current house and renting it out and going and buying another one, but that's not the majority here. And you know what?
Not even close.
It's not. Yeah, I mean, it's minute. And the majority of the population, though, is on board essentially with, hey, well, the Fed must know what they're doing. But what we're already seeing is, and I'm seeing this on the ground level, we've already got a lot more homes coming to the market right now, Louis. Now, is that a product of just rising home prices where now people want to test the market because they've gotten some equity and they're trying to get out?
Yes.
Or, you know what I mean? I think that's the first thing that's going on there. And then the other one is that a lot of people were like, okay, well, we were hoping that interest rates were going to come down, but since they look like they're going back up, we're going to go ahead and try to sell and move on now. So you have a little bit of that, right?
Absolutely.
So it's a combination of things that's going on. But what I actually see, as we move into next spring, I'm really going to watch the inventory levels and what interest rates are doing, because this uptick in interest rates that we've had over the last couple of months of greater than 1%, it's going to drastically change buying power for a lot of people. And I'm going to be curious to see what home prices do, because I have a feeling that they're going to start to level off and actually start to go backwards a little bit.
Well, they should.
Then that's what should happen, right? Now, depending upon what the Fed does, and in my opinion, they won't do anything through the end of this year. I mean, like you said, they've already bought themselves through October, which will probably go to November, which will probably go to December, which will probably go to the beginning of the year before anything ever gets sorted out. Which at the end of the day, what can actually get sorted out in the government? I mean, I don't see any other way around it other than the Fed, basically the Treasury asking the Fed to print more money.
Which in effect, Ryan, would be a further increase in QE.
Yeah, but
they can call it emergency measures or whatever they want, but it's still the Fed printing more money.
Exactly. They'll call it some crazy program, right? And
temporarily, though. They only do it temporarily. Like QE's been going on for 5 years temporarily.
Yeah, and it's so bizarre because, especially in the real estate and mortgage markets where you're trying to, give good advice to your customers and clients, and, our economy is so dependent upon what the Fed says and does at this point. It's scary. I mean, really what they're doing is really detrimental to our overall economy in the short and long term. And it's just a matter of when are we going to get to that point, Lewis? And you and I have talked about this a lot. Could it be next year? Could it be the year after? Is it 6 months from now? Is it next month? I mean, what would be the tipping point? And at this point, I'm kind of convinced that it doesn't look like there is one.
Oh, I think there is, Ryan. Go ahead. Why do you think there is?
Is it 5 years? Because I just think that, well, I'm not saying inevitably it can happen, but I'm just saying that I think that we're still maybe 3, 4, 5 years out from that.
No, I don't think so. You see, I think what all of us have learned is, it goes back to the Keynesian, markets can stay irrational longer than you can stay solvent. But eventually, manipulation and schemes get overwhelmed by markets and reality. So it is inconceivable, and of course I'm not going to predict the time, that the United States can continue to fund itself and its economy via printing money. So at some point, and I think that point is coming soon, because and you see it, the reason they bluff about tapering is because they know they can't. There's too many structural problems they've created by the Fed owning $3 trillion worth of mortgage-backed securities. If they stop buying them, rates go up, the economy craters. The United States can't afford to pay higher interest rates, which means government services have to be cut because we can't do more deficit spending at higher interest rates when we already have done too much spending at low interest rates. The Fed has to be paid back. They can't be paid back $3 trillion, so the Fed has to keep buying. At some point, the whole thing absolutely has to collapse because you're talking about such huge numbers, and you're also talking that there's been not one step made in the direction of solving the problem. They're papering it over and papering it over and printing more money and going further into debt. At some point, that cannot be sustained. And we've seen, just because something hasn't happened yet doesn't mean that it's not going to. And that's the point I think I want to make, is that because something hasn't happened, people get lulled into this false sense of security. We haven't had inflation yet. See, I'm right. Therefore, right. You were foolish to worry about inflation. No, you were just a little too early in worrying about it, because there already is massive inflation in the money supply and the increase of the supply of money and credit. And you are going to, and you have seen increases in gas prices, housing prices, in selected asset areas where the money, the increases have gone to assets that are generally held by wealthy people. Well, you can't have a situation where all the money ends up going to what they call the 1%, and then there's no jobs and inflation hits the masses. That's not sustainable, because you can't have an economy that's based on only a very small portion of the population making any money and everyone else going further behind, and eventually that catches up to you. And eventually it even catches up to the people making the money, because their assets are so inflated, they're going to crash, and then whatever wealth they think they have, they get dragged down. So this whole 5 years worth of QE has not produced a productive capacity in the United States, hasn't produced anything tangible in terms of job growth, wage growth. It's only produced in a relatively small increase in housing prices. It hasn't really pushed up the wealth effect. It has produced a large stock market increase. But if you look at the stocks that are doing well, a lot of them don't even make any money, and a lot of them that have gone up in price over the last 5 years haven't really sold more. Their revenues aren't higher. It's just they're higher because their earnings are better, because they fired people and they did stock buybacks with the free money that they were getting at the low interest rates. So even the stock market itself, while it doesn't look overvalued from an earnings perspective to shares, it is overvalued in the sense that these companies aren't really doing 100% better Their sales haven't increased 100%. Their profits have gone up. So we don't really have anything beyond the illusion of this wealth that's created through the increase in the money supply and the lowering of interest rates by the printing of money. That can only go on for so long. And I would say it really can't go on more than another year or two.
Well, see, and I think more to my point was I knew that it's gonna end at some point, right? But you and I had talked even 2 years back that we thought that it was coming in like a year or so. You remember that? And I'm just at this point, I'm almost convinced that the illusion effect it can last quite a long time.
It could be right. We predicted earlier that we only had another year or two of this left.
Yeah, and that's why I'm just watching all this. And do you actually think that something like this is going to come to an end on Obama's dime? Do you actually think that? Because I know I don't. I know that there is no way in the world that they're going to let his legacy be tarnished by, an all-out collapse. That will not happen on his dime. So
and it won't happen on Bernanke's in the next 3 months. So he's thinking he's got to skate out of here and pass it off to Yellen or somebody else. And he doesn't even want to think, start, or talk taper before he leaves now.
Oh, 100%. Yeah, you're right. I mean, nothing's happening for the rest of this year. But then as we move into next year, really probably we're not going to get anywhere. And we're going to continue the onslaught of economic news. One week it'll be good, next week it'll be bad. One week it'll be good, next week it'll be bad. So
we might taper, we might not taper.
Right, and because you know why? These stats that are thrown out there, all this economic crap from the BLS, I don't care about it. I really don't.
Is it any coincidence that it's taken over a month now to fix the initial jobless claim data coming from the states?
Oh,
we haven't had a good reading on that. Not that it's that important, because just because fewer people get fired doesn't mean anyone gets hired. But still, they can't even get that number right.
Well,
but of course, it's a lower number because certain states don't report, so the top line number looks good.
Of course it does. And, I mean, the whole way that data is even retrieved, by the way that they survey people, I mean, I don't know. To me, it's all a sham. I don't really care about any of that data. I mean, you could pretty much find out everything you need to know by talking to people on the street. And these numbers don't mean anything. The only thing that these numbers
We should start a new economic school of thought just based on talking to people in the street.
And you know what? More times than not, you'll find out how bad or how good things really are.
I agree. Than doing some Keynesian economic model, plugging in numbers, and then proving that something's going to happen 3 years from now because the government spent money over here.
Right. I mean, think about it this way. We could actually do a test, Louis. We could line up 100 people. We could say, how many of you 100 actually have a job right now, right? Okay, how many of you have actually been able to obtain a mortgage in the last 3 to 4 years? Right? You start asking all these questions, and you know what? You're going to find them all you need to know. You know what I mean?
Oh, yeah. Do you have a full-time job? Do you have a part-time job? Right. How much money do you have saved? What is your credit score? Can you obtain a mortgage? You're not going to find, if you did a cross-sampling, you'd have to do more than 100, that there is a huge pipeline of people that are in the financial position because of their job, their prospects, and the amount that they have saved that are able to buy homes.
Not only that, okay, great. We see that the stock market's up huge. So how much is your portfolio gone up? Oh, what do you mean? I don't have a portfolio. I got wiped out the last
I've got the $2,000 that I have in my 401k plan that I've had for 5 years.
Right, and see this.
So what? It used to be $1,200. Now it's $2,000. It was $2,000 5 years ago. Now you're back to where you were. Are you going? Does that mean you're now in a position to go out and buy a house and start spending money? No. It means you're just not as bad off as you were 4 years ago.
Exactly. I mean, and so when we get these economic reports, which is basically skewed and made to fit however the Fed and Congress wants them to be, because they obviously have some sort of master plan of the way things need to be manipulated to keep people in the dark or keep people with the illusion that everything is fine, just like we said, with the stock market rising, home prices rising, mortgage interest rates going lower. It all gives, I guess, the sense of feeling that things are just peachy. But obviously that's not the case. And it drives me nuts because there's so many reports, and you and I discuss them all the time, Louis, because we have to basically figure out, okay, well, this is what's probably going to come out, and how is this going to affect things? Because I still need to explain to my clients every day, okay, this week we have this on deck. This is what could potentially drive rates up or drive rates down. And the craziest thing is that I feel like I'm talking about the Fed every week, but that's only because I have to.
But you're right, and most people don't take, and that's what the Smaulgld blog does. There's really not another blog like it that I'm aware of that takes economics and applies them to real estate. Most of your real estate commentary, some of your mortgage commentary does take into it. All of your mortgage commentary takes into account economics, but most of your real estate commentary just talks about why it's a good time to buy a home, or just regurgitates the economic facts that support the contention that there's a housing recovery and that it's a good time to buy a home or a good time to sell a home.
Yep. I mean, how many? I watch CNBC every now and again just to see what guys are bringing on there and see what they're saying. These companies, the CEOs of these companies, I don't ever hear them. I want somebody to ask the question: do you not feel that what the Fed's doing is going to be detrimental to our economy long term? And what do you think they should do? They don't ever ask questions like that. The only thing that they'll ask them is just say, hey, well, obviously it looks like QE's been working. Look where the stock market's at. You know what I mean? It's almost like they push the point home. They have to continue to push that point that it looks like business is doing well because they can borrow cheap money. It looks like the stock market's doing well. Looks like housing's doing well. Nobody's actually came out on any of these shows and actually questioned the Fed. I mean, the last person to really...
Well, it's not in their interest to do so, Ryan. Isn't that the tragedy of the commons, the classic example where if you give people free stuff, for example, I think the example that the guy who invented the concept of the tragedy of the commons is that if there's a pasture and everybody can come and bring their cows there to graze for free, and therefore you can save money, everyone's going to do it. But what's going to happen to the pasture pretty quickly is, since nobody's paying attention to it and no one's trying to preserve that asset, everyone's just going to come and take and leave, and the pasture's going to be ruined. Well, right now, it doesn't really do these CEOs any good to question what the Fed is doing. If there's free money and it's helping them, they're going to take it, even though they can even know that it's going to harm the economy and ultimately them. But what are they supposed to do? Not take it? And it's the same what happened, if you remember, if you were an honest bank and you said, I'm not going to lend to these people, they're not good credit risk, I'm going to keep a conservative loan portfolio, you would have gone out of business in the early and mid-2000s. You could have questioned, well, I shouldn't make this loan, but they took that question out of your head by saying, don't worry, make the loan, and Freddie Mac or Fannie Mae, whoever it was, is going to buy it from you. So go ahead and make it. You don't have to worry about it being on your books.
Right.
So people are given incentives. They may even know that what they're doing is wrong, but they're being paid to look the other way and not to question it. And some people don't even know what's happening. They just think, the world is shining brightly upon them. They're doing well in business because they're doing well. So what's there to ask, and what questions do I need what questions need to be answered?
Yeah, I mean, what's interesting, I think it was a recent Wall Street Journal article. Their headline, I think, was something to the effect of that housing inventory is making a comeback, and that inventory of homes is now beginning to reach more of normal levels. And obviously, that should happen at some point. And we just kind of touched on it briefly earlier. I mean, obviously, when we have had an increase in home prices over the last year or so, and the D.C. Metro are substantial increases. I mean, in some areas, 25%, 30%. I mean, So what's that?
I said, That's a word.
And so with that happening, obviously some of the people that were right on the cusp of being able to break even on their home or maybe make a little bit of a profit, they're naturally going to come back to the market. But like I said, where I see the real test is once all these homes do come on the market, say next spring, because I think there'll only be a little bit that start to funnel in this fall. There's already been more this fall, a lot more this fall than there was last fall, and that's a direct correlation to rising home prices and interest rates. But when we go into next spring, I want to see where we're at and what the inventory levels are next spring. If interest rates remain in the levels in the mid-4s or maybe closer to 5, what we see home sales do then. Because it's my thought that, with everything remaining equal, we know that incomes are not rising at this point, right? We know that employment situations are getting much worse. So something's got to give. It's either prices are going to go down, or we're going to start having more creative mortgage products come back to the market, and the guidelines are going to have to loosen up, right? because there's probably a lot more loans getting denied right now than approved. That's for sure.
Well, also, Ryan, there's not much of a volume, really. And also, you mentioned earlier in the show that the new home sale was 423,000. I just want to point out that is an annualized production rate, meaning I think there were 34,000 homes sold in August, of which I think 15,000 weren't started yet. But 430,000 homes a year built and sold is 3.5 times less than were built and sold in 2005.
Right.
So that small amount of homes being built, and I do believe that home building is a positive job creator for the economy. Well, but that's not that many houses being built to really have an impact on the overall economy, because it's only 400,000. It's not 1.5 million like it was in 2005.
Which is triple that. I mean, even if we only had even if we had it closer to 1 million, I think that would be, we could put a lot more stock in it. But yeah, as you say, I mean, 400,000.
Correct. That means there's not that much demand. It's just a bounce off the bottom from like 280,000. It's not really some mega growth that we're seeing. You know about the power of big numbers. This is the power of small numbers. When you're rising from a small number, you can have these massive gains.
Well, and that's what's comical about the same way that we look at these jobless claims. You know what I mean? Like, they think that an improvement from 320 to 310, that's a big number. You know what I mean? Like, really? Like, because whatever you think that you just gained in that 10,000, there were probably 20,000 people that just stopped looking for work, right?
Well, still a large number of people each week that are basically potentially leaving the labor force, because when someone files an initial claim, that's the first step towards not ever working again.
Right.
It's not like you file an initial claim, you get help for a short period of time, maybe a year, maybe you get extended benefits, but eventually you get a job. Many of those people never get another job because either they can't, they don't want to, more likely because they can't, and then they end up on food stamps or relief. And that's not their fault in a sense. It's the fault of the economy because there's not a job there for them.
Well, and then,
why isn't there a job there for them? The economy isn't producing those jobs. Because they would go and get it. Most people, I don't believe the myth that people would rather get unemployment, because at some point that runs out. There are some people that do. There's clearly people who would take advantage of anything that's given to them. But most people want to go to work, and they would take a job if they can get it. But they're not stupid. They're not just going to take a minimum wage job where they make less than if they're on unemployment.
Yes. Well, and see, here's the thing, too, Louis. In the real estate world that I'm in, and I'm basically trying to help people buy and sell houses and obviously obtain home mortgages and things like that. That initial jobless claims number is very important to me because you know what that's a red flag for? If that number is not really getting drastically better, it just means that, more and more people are basically don't have jobs. Well, when you go to apply for a mortgage, we've already talked about this, but you basically need 2 years consistent history, and all of a sudden you have an initial jobless claim. That person then, you could probably get away with a very small gap in employment, but once you have a year gap in employment, good luck. So then, a year gap, you're going to need another 2 years of consistent history before you can ever buy a house, right? So there's millions of people out there right now that have either gotten laid off from their job temporarily, or they took a short-term stint where they were trying to find another job, which created a gap. Once you have that gap in employment and you go to apply for a mortgage to get a to get a home loan for your house that you're trying to buy, good luck.
And also, if you have that gap and you've just got a job, well, guess who's the first person to lose the job? The person who got the last one. Right. So that person is very much disadvantaged because not only have they been out of work, they finally find a job. They're probably going to be most likely to be the first person to get fired. And if that happens now they have two gaps because now they have to go back on unemployment. And now, for purposes of getting a mortgage, it looks like their career history is really spotty, and perhaps through no fault of their own other than, and this is especially true with younger people. They may have entered the labor force, as the last employees hired, got booted in a restructuring, finally found another job come in, and they get booted again.
Well,
So how do they build up a solid career path? How do they even think about buying a house? They have the student loan debt, and they have this career history. It makes it look like they don't want to work. Because I've seen it. I've seen it with employers. where they see somebody who's been out of work and they've been laid off and they start raising their eyebrows, they think, well, maybe this guy just couldn't cut it. And
right.
Sometimes that's true because when you do layoffs, obviously you don't lay off the best people, but sometimes you do lay off very good people.
Right.
But from an employer's perspective, they don't want to take that chance that they're not, that they're going to rehire somebody who really wasn't good at their last job. And in most cases, that's not true.
Well, if you had your pick between somebody that's been unemployed for 10 months and actually another candidate that's trying to come from another company to your company, which one would you rather have?
You take the lateral. Now, the lateral, though, however, could have many problems. They could be leaving their company because they're in bad standing. They haven't been fired yet. And the person who's not at work for 10 months could be a stellar employee.
Yep.
But you're right. It's a safer bet for the HR director to make a recommendation to hire somebody who already has a job. And that's a self-fulfilling prophecy.
Yep. If they recommend the guy that's been out of work for 10 months and he shows up and he doesn't do his job, then it's the HR person that looks like an idiot, right?
Exactly. And that person ends up having a career gap because he gets fired. She gets fired.
Well, I mean, at the end of the day, it's a very vicious cycle, wouldn't you say? I mean,
absolutely. And the only way
is.
to get out of that is if you make it easier for employers to hire and fire people without consequence. I know it sounds crude, but it actually hurts people if you have job protection, because if you finally do get laid off, it makes the employers that you go to next much more unlikely to bring you on. And this has nothing to do yet even with the cost of Obamacare. So the employment situation I don't see getting better. And then if you tie that back to housing, how can housing get better if the employment situation gets better? And to make matters worse, the Fed really can't do anything about employment, even though it has that dual mandate of full employment. I mean, they've printed as much money as I think they can print. They can double it down. But they really haven't done anything other than lower the unemployment rate, which Bernanke admitted finally that perhaps isn't the magic number or percentage to look at as the unemployment rate, that he has to take into account other things like labor participation rate, which is at an all-time, not all-time low, but a 32-year low, and it has to take into account wage growth and job growth, not just what the unemployment rate is, because you can get the unemployment rate down to zero if everyone just decides not to work. I mean, it's not really a good indicator of the health of the job market.
Well,
so that's really where the problem is.
And to go from $85 billion a month, right, and to get us back to some sort of normal market, I mean, we'd have to see a huge increase in employment, right? I mean, it'd have to be a massive increase in employment. It'd have to be a massive increase in the production, the overall production of companies.
How does buying mortgage-backed securities create that massive increase in production? It doesn't.
It doesn't, which is the primary.
You can do more of it. It's not going to help.
Right, which is the primary reason why this is such a crap situation, because, you know, the only thing that they know that they can do is to continue to basically devalue the dollar and print more money, and inevitably this is bad for everybody.
Right, I'd be more in favor of a Keynesian approach of doing government spending to build stuff, you know, that doesn't necessarily need to be built or wouldn't be built in the free market, because at least somebody would have a real job, even though it was government produced. But this is just giving money to the banks to buy mortgage-backed securities and buying U.S. debt. It doesn't create real economic growth.
No.
I'm not advocating that the government then do another stimulus. However, there is some argument that when you do stimulus, the money goes directly to the market participants, even though the government has a hand in where it goes, and you have a whole bunch of issues with crony capitalism and corruption and so on. But at least the theory is you can try to justify that it goes to the economy.
Well, there for a second, it looked like we were getting ready to jump right back into war, which is still not off the table by any means, like you said, Lewis, because typically when we need a distraction, that's something that we turn to, right? So
we have the debt. I think now we have the debt crisis. I mean, the debt ceiling, so they can stop worrying about Syria. Or they may have to use the two of them together.
Well, they might have to, and we'll deal with this debt crisis for who knows how many months at this point. Obviously, you know.
I mean, is there a solution other than kicking the can down the road again? I mean,
I think that's my point. Is what is the only, and it's not even a solution, right? It's just the only thing that they know how to do is to kick the can down the road and worry about it later. So, who ends up getting stuck dealing with this, you know, are paying the real price for this in the end.
Younger people.
Yeah, the younger people. I mean, it's unfortunate that that's taking place.
Gen Y, millennials, whatever you want to call them.
I mean, we have so much, supposed brain power there in Washington, but nobody really wants to actually deal with the facts. And the facts is that all of the BLS numbers and all the other statistics and all that stuff that we talked about earlier doesn't mean anything. The Fed is manipulating the economy. There is no real economy right now. There is no real economy. Real economy is that the Fed
it's Fed market intervention.
Right. And the real economy is with basically no Fed purchases of treasuries or mortgage-backed securities. Interest rates would naturally rise up to 6-7%. Investors,
and they would go down based on other market conditions as they improve.
Sure. Absolutely. And private investors would come back to the market and lend money again to individuals because they're willing to take a risk on that. At this point, nobody's willing to take any risk when they're looking at it as basically free money from the Fed. Who wants to take a risk? They don't want to take a risk. So if you have a borrower that's, a potential risk, but you know what, they've got enough assets and other compensating factors that you could see taking a risk on a loan for them, and you're willing to give it to them because, they've got that. Back when, they might have taken that risk. But now, today, where we're at, no chance. And
think about all the people like yourself, Ryan, new generation mortgage brokers. You grew up not thinking lending standards, but thinking what the lending standards are is dictated by the government.
Absolutely.
So you don't take a free market approach to, there are portfolio loans, but they're such a small percentage of the market.
That it's almost pointless to talk about those because they're so few and far between. I mean, the people that can take advantage of them, it's great. And I always do send people that way to credit unions and other places that might have products.
Savings and loans and so on.
Right. Yeah. But for the majority of the population, that's just not a fit, unfortunately.
That should really, if you think about it, all other loans are, in a sense, welfare because they're government-backed. It really should be the other way around, that there might be small programs for people who can't otherwise qualify with norm. But basically, it's the reverse.
Yeah, it is. And, like I said, it's with all the government regulation, new rules and everything, qualified residential mortgages, all these different things that are going to come into place. At the end of the day, there's still the government that's basically backstopping all these mortgages. So at any point in time where things start to fail, they'll just change them and they'll alter the rules as they see fit to make sure that things don't fall off a cliff.
Yeah, so you don't really learn good lending practices as a young mortgage professional. You learn how to follow those rules.
Yep, exactly. Yep.
And therefore, your entire mindset is based not to question how things are because you never knew how to do it the real way in the first place. You just start thinking about how do you lobby to change certain rules.
Of course.
Or you ask for more government assistance, you ask for low rates, but you never think that you want to do things the way you would naturally do them because you've never done them naturally because your entire life you've been in this system.
Yep, and you're scared to give good advice that you think would be beneficial to clients because you're afraid of the rules. You're afraid of somebody coming after you for saying something the wrong way. I mean, it's such a shame. I mean, so much has changed. And
that's what holds back an economy. And the problem with economics, you really can never prove your point of view because you can't do A/B testing.
Right. Yep.
You could say it would be like this. And when it was like that, back in 1910 or something, or 1920, the classic response is, oh, do you want to go back to the days when the average life expectancy was 50 years old and, the child mortality rate was 20%? No, that has nothing to do with it. The two are not connected, but when you talk about wanting to return to free markets, you get the immediate response that somehow you're cold-hearted and you want to go back to all the abuses that occurred in the 1880s and in the 1900s.
Yep, it's definitely interesting times, my friends. We're coming up on the end of the show, Louis, but I wanted to let our listeners know if they want to check out your blog. Give your web address again. Let them know where they can go to look at your blog and
it's
contact
basically,
you if they have any questions.
Sure, it's Smaulgld.com, SMAULGLD.com, and on there I have a almost bi-weekly analysis of economics and real estate. I'll be posting something this week on the Fed's recent move or lack of move and what it means to real estate, gold and silver, and the stock market, and to the economy in general. And you go there, Smaulgld.com, SMAULGLD. You can also contact me through the website as well, through the About section. Thank you very much, Ryan, and have a good week, everyone.
All right. Thanks, Liz. Appreciate it. Thank you guys for tuning in. Like I said, if you want to reach out to me, you can contact me at 877-245-2030 with any questions you may have, and or our website to check out our podcast we do every week, which is realestate360live.com. That's realestate360live.com. Until next week, guys, have a great week.